Hello, my name is Joe HOYLE, speaking to you from the University of Richmond. We're getting ready now to talk about Chapter 4. And you'll find when you read Chapter 4 that there's a big change here. The first 3 chapters focus on reporting financial information. Chapter 4 talks about gathering financial information. Gathering information is very necessary if you're going to produce fairly presented financial statements. You have to gather the information in order to produce those statements. It's important for you to understand, to begin with, the term transaction. A transaction is anything that has a financial impact on the company. For example, if you buy inventory on account, that is a transaction because it has a financial impact on the organization. If you borrow money from a bank, that's a transaction because it has a financial impact on a company. If you sell a service for cash, again, that's a transaction because that has a financial effect upon the company. So when we talk about gathering information, we're going to look at 4 very specific steps. 2 here in Chapter 4 and then 2 more in the next chapter. When you're looking at transactions, the 4 steps that you need to know are that you first analyze the transactions so that you know exactly what took place, the impact of that transaction. Then you record that impact so that you have it recorded so that you can make use of it when you get ready to produce the financial statements. Third, you adjust that information to make sure before you produce the financial statements that everything is fairly presented. And finally, you report the financial statements. You actually produce them and you send them out. So when we talk about transactions, the idea of analyze, record, adjust, report is a very fundamental to the production of the financial statements. Here in Chapter 4, we start by looking at the analysis, what we call transaction analysis. And transaction analysis is nothing more than looking at an event and coming to understand what has changed. I often tell my students that if you can tell me what has changed, then I can record any event. You have to be able to take that transaction, look at it very carefully, and come to understand exactly what has happened. Here in Chapter 4, we'll look at some easy transactions. For example, if you buy inventory on account, then your inventory goes up and the amount that you owe, accounts payable, also goes up. That's transaction analysis, and you can do that. If you borrow money from a bank on a loan, then your cash goes up, as does your note payable or some other liability. Again, you can figure that out. You can do that. That's a basis to understanding how to record financial events. If you make a sale of a service and get cash, then cash goes up, and it goes up because you have sold something, so that's a revenue. In looking at these transactions, notice one very important step, and that is that at least 2 accounts were impacted by every transaction. Now sometimes there are more than 2, but there has to be at least 2. You bought inventory on account. Inventory and account payable both changed. You got a loan from a bank. Cash and your note payable both changed. You sold a service and got cash. Cash went up, as did revenue. There's always 2 accounts that are impacted, and the reason is that there's a cause and effect to every transaction. The inventory went up because you are willing to accept the liability. Your cash went up because you took the bank loan. Nothing ever occurs without some cause and some effect. So when you're looking at analyzing a transaction, keep in mind that at least two accounts have to be impacted. Once you have analyzed a transaction, you need to record it. It is at this point that double entry bookkeeping comes into play. Double entry bookkeeping is a system that has been prevalent in the business world for over 500 years as a way to keep up with the effects of transactions. What double entry bookkeeping does is to start out by trying to have an account, a T account actually, for every balance that you're trying to record. So you would have a T account for cash, a T account for revenue, a T account for inventory, a T account for rent expense, and so on. Now, it's shaped like a T, so therefore there's a left side and a right side. Double entry bookkeeping starts off with the premise that one of those sides is an increase and one of those sides is a decrease. And we go back to ancient terminology. We refer to the left side of a T account as the debit side. That's all the debit means. It's the left side of a T account. The right side is referred to as the credit side. And again, that's all the credit means, the right side of a T account. And over 500 years ago, they established rules as far as whether the debit side is an increase or the credit side is an increase. And that rule is basically that your debit side is an increase for expenses, assets, and dividends. Now, I know that sometimes starts off by being a bit confusing, but there's only three that start off with debits being increases: expenses, assets, and dividends. And if you work with this a little bit, you'll be amazed at how quickly you get that under control. All of the other accounts increase by credits: liabilities, capital stock, retained earnings, revenues. Those accounts increase with credits. So once we have the idea that a T account has a left side, a debit side, and a right side, a credit side, then we need some way to record the impact of the transaction in that account. We do that in two ways. The first way is through a journal entry. The journal entry is the historical recording of the impact of a transaction. So if, for example, you do buy inventory on credit, then the impact on inventory and the impact on accounts payable is recorded in a journal entry. So every transaction will have a journal entry. So if you go to a business and you look at the journal, you can see a listing of every transaction the business has. Then those balances are posted in a T account. So you have a T account for inventory and the journal entry is posted to that T account. You have another T account for accounts payable and the portion of the journal entry for accounts payable is posted to that T account. The T accounts are kept in the ledger. Now, I realize that this may all be totally new to you, but do realize all we're trying to do here is first analyze the transactions to determine what went up and what went down, and realize that at least two accounts are affected every time, and then we're recording that first in the journal where we make a journal entry for every transaction, and then in the T accounts or in the ledger where each account's balance is monitored. So if you want to see something that occurred on Monday, for example, you would look in the journal. If you want to see the balance of some account, you will look in the T accounts found in the ledger. Now this ought to give you a good start on reading chapter 4. So look for things like transaction analysis, debits, credits, T accounts, journal entries, ledgers. Certainly it will take a little work on your part, but we believe that once you get this, then the gathering of information will be something that you do understand. Enjoy Chapter 4, learn it all.